Hello, folks. Brandon Chapman with you today. It's another edition of Monday video for TheoTRADE. It's Monday, November 27th, 2023. As we escape the kind of post-Thanksgiving week where lighter volumes, tighter trading ranges abound, as we enter this week, today was really no different. The range was relatively tight. The market finished basically unched or slightly down. And today we posted a rather significant print on the SPY at 455.36. You can see this on the trade flash over here. It says buy. Don't worry about buy or sell. Just worry about the number of shares in the print. This shows greater than 1 million shares traded in one print today at 455.36. This creates a rather significant level. And one thing I wanted to point out here is that during this rally, we've had a number of large prints, 5 of them to be exact. We also had one back on 10/23. This is not something that should happen regularly, but it's become more of a regular theme. And this sounds very much like 2021, where we had a lot of these sorts of trades as we entered late November, early December of 2021. And this is something that led off before we saw a major correction in the market or downtrend bear market of greater than 20%. We saw this kind of changing hands. And so the idea is, as we look now, is there the potential that we're seeing going into this high, into the peak right now, that we might be seeing some large blocks of shares being sold or traded, the strong hands selling to the weak? And this has been a historic rally. I mean, it's been a phenomenal rally in the S&P 500 off of the lows to our kind of recent high, about 11.5%. And so it makes sense that we might take a breather here. But at times, we've seen the breather only result in more upside activity in the market. And that ultimately is something we're trying to figure out right now. We're trying to make sense of, is this just a head fake the last few days and only going to lead to a higher or a more bullish move in the market in the coming weeks? And this is something where I like to look at, the volatility markets, right? The VIX, the term structure of volatility, and other things that may give us insight over where the market may be headed. And so as we look at the VIX, we'll start there. This is the 30-day volatility index. Notice how we're at the same low we were, for example, in September, July, and going back to June. We've been at this kind of 12.5 level several times since last June, and almost every time it's resulted in some degree of correction in the market. June 22nd, we have July 27th, we have September 15th. And so if we look at the SPY over those periods of time, how does it correspond with highs? You know, June 22nd was kind of up here, right? July 27th was right here. September 15th was right here. And so these generally correspond with high levels in the market preceding the bigger corrections that we've seen. However, the VIX isn't necessarily perfect in terms of its timing. So what I like to look at is the term structure of volatility. So I take the 3-month VIX and I divide it by the spot VIX. And from this, I want to take away the composite, which is the candles here. I want to focus on the relative strength of 3-month VIX to 30-day VIX or 1-month VIX. So when this gets north of 1.2, what that means is the 3-month VIX is 20% higher than the spot VIX. We got this trigger or this signal last Wednesday, ticking lower today, but today's value is 1.2. We're still seeing that the 3-month volatility is greater than 20% higher than the 30-day volatility. This is a problematic area. It's an extreme read on where the market is expecting volatility to go, which is up in the future. Notice we reached the very same level. If we go back here to this peak right there, September 14th, we had September 1st. We had back here, for example, July 14th, the 21st, again, touching here on the 26th and 27th, 28th. This kind of, getting above this level several times in mid-July. In June, we hit this 6.2, then came back around again on 6.16. And so when you see these kinds of signals, it just says, look, the market is expecting some rather high volatility in their future. There's the 15th of June, right? There's the 27th of July. There is the 14th of September right there. And there's the 1st as well. So when you get these kinds of signals, it says, look, watch out for the downside. And so when you see this going north of 1.2, it suggests we might be getting a 5 to 10% pullback in the coming weeks, and usually about 3 to 4 weeks. And I couple that with skew. So if skew is north of 130, that tells you something, right? Yesterday or Friday's value was at 144.50. So we had this trigger of very high back month volatility and high skew. What does skew tell us? Skew tells us is that the crash risk is peaked. We have long tails to the downside. However, you have the mode, which is the most frequent, and you have the mean here. What that means is that the mode is greater than the mean. So expect in the interim to have a high frequency of small up days, but the crash risk is rather pronounced in terms of how they're pricing in volatility. And right now we're seeing that coupled with the fact that back month volatility is rather high. And again, this is generally commensurate with downside risk in the market. Again, a 5 to 10% correction, in the coming several weeks. Last week I walked through, I'm gonna go to the Analyze tab here for the SPY. I walked through a process of how to hedge given the low degree of volatility of basically this is a proxy of buying, 100,000 of SPY, 219 beta weighted delta, buying 2 puts, trying to reduce that by 30%, and then offsetting much of the cost of the puts by selling call verticals, which is benefiting by the high skew. And this is one way to be able to reduce portfolio exposure, right? So if I take this off, you'll notice if we were to get a correction to, let's say, where's my slice on this? It's down here a little ways, 2,375. Okay, portfolio's down 17,000. You add in a hedge like this, you're down 3,000. Much more palatable, right? And as this put goes in the money here at 448, you could just roll it down and take something out of it. So the loss might be bigger if you roll it, but it provides the upside because the market goes down here and starts to rally. You don't get a whole lot out of it. So the idea is as that put goes in the money here, it's like about maybe a 0.6 delta or something like that. You would roll it back out to that 30 delta-ish and just take off whatever credit is there. And you're trying to allow for the upside if the market retraces. And of course, the market goes down, you take off these call spreads here, which are double the long puts purchased. And again, this just provides a hedge. But right now, if you're thinking about the bigger picture, right? I mean, we are in a bearish market. And why do I say bearish market when the market's up 11.5%? Just go back to our highs from late 2021, early 22. We're basically 2 years down the road, and we are not at a higher high. So the bear market still remains intact. The Fed has raised rates substantially. And right now we have forecasts of the Fed cutting rates next year up to greater than a 50% probability. They cut rates greater than 1% or greater. And so you don't have that scenario without having very uneasy market conditions. So it makes sense that this might be a time to consider taking profits and potentially reducing your allocation to equities and hedging. And what that might look like is you take down your 100% allocation that you currently have, you book about 30% in profits. Now you're left with about a 70% exposure, and then you hedge a third of that or 30%, and you're now down to about 45 to 50%. You've effectively reduced your exposure in half through hedging and profit taking, and now you're prepared for a downturn in the market. If you're still not comfortable with that level of exposure, you probably need to sell more. There's no need to be long the market in perpetuity, okay? But this gives you an idea or a signal to say, hey, maybe you reduce your allocation equities, you take profits on 30%, and you hedge the remaining by about a third, taking your net exposure down to 45 to 50% compared to what it was today if you haven't taken any of these measures. So this is a very powerful thing you can do to help reduce your portfolio exposure for a period of time, right? And then eventually as hedges come off, you could potentially reallocate back to equities, maybe on the next rally. But we don't know, is it going to be 410? Is it going to be 390? Is it going to be 435? The point being is a 5 to 10% correction is reasonable. I'm adding the extra kind of indication to say, look, you might allocate more to cash just because of the overall market conditions and the potential hostility that we might experience next year. So take this as your warning. I did the same thing back on July 27th. You don't know when there's going to be a high. You can't predict the highs, But this gives you kind of an indication of how hedging, institutional hedging in the options market are reflecting their expectations. And it says right now, boy, you may want to take some profits. Doesn't mean everything's going to go down. And we look at some of the stuff that went on today. For example, GLD, gold was about 0.67% higher. If you look at gold stocks, they're about 1.6% higher. Now, I'd placed a bullish vertical trade on GDX, I think back on the 14th. I closed that out for about 74% today as I'm getting close, not maximizing, but again, that last little bit takes a lot of time. And I had a late December 29th expiration. But we also saw more option activity come into the gold market, specifically with stocks like, for example, Barrick Gold. Barrick Gold was up 2% today. It's kind of lagged the movement of the market. You'll notice there's kind of a shoulder ahead and another shoulder. We're potentially very close to breaking out here, which may lead to just take $3, add to 17. Could lead to about a $20 target in the coming months. And this is seasonally, as we enter December into January, a bullish time for gold. Now, November kind of stole some of the thunder there, but it doesn't mean we can't continue to see upside here as the dollar weakens, as interest rate expectations start to temper. The data side tends to be more bearish. And so as a function, recessionary pressures are there, as well as the possibility for weakening the dollar. And right now, we don't have that pressing kind of dollar squeeze as we're seeing a major kind of deflationary or disinflationary sell-off. So what we're probably expecting going into the end of the year is not necessarily some profound, fast sell-off, because there's been a lot of hedging that's transpired here, but certainly could we see the market 45 points lower? Could we see like a 410 handle down here? Yeah, we can, right? Could we see something that's closer to 5%? That's more likely, obviously, but could we see something around 430, 432? Yes, we can, right? This would be a pretty easy result, and it's not going to push the VIX all that higher. As I've said, there's a lot of hedging that's already transpired, and so we might just grind going into the end of the year. We had a similar scenario back here. We had a couple of bigger down days, and we just kind of grounded out into a bullish kind of open for 2023. In this case, we stole a lot of thunder or a lot of future return to push it to the present, all based on the notion that the Fed is going to cut rates next year, which is not exactly good for the market, right? It's good maybe after the fact, but it's the pain in the transition to get there. So be careful up here, right? This is a point to be cautious. That's cautiously bullish, meaning you're reducing your exposure and hedging the potential downside risk. But stock like gold could continue to go higher, GLD. Also Newmont today. As we look at Newmont, I think it's a 1 December. There was some bullish option activity out here in Newmont on the front week expiration as well. Again, Newmont's relatively underperformed. Gold, could we play catch up here and push towards 41? The nice thing about these kinds of companies is that the term structure of volatility is favorable for buying a lower strike and selling a high strike, right? You could buy a 40, sell a 42.50. There's a slight edge in there. You could buy a 40 and sell a 45. There's even a bigger edge. It just requires the market to move higher. But could $45 be a reasonable expectation by Jan 19, 53 days from today? Again, coupled with the seasonal trends in gold, like we saw last year, result in a rather big move in Newmont. Very similar scenario where we have kind of a bearish market expectation or economic expectation, weakening economy, and a weaker dollar that may push. So you can see back here, for example, the run from mid-December up into the end of February, leading to about 80 from a low down here of about 51. Could we see a similar result from Newmont again? Doesn't have to be that big. Maybe it's just a run to 52, right? So that's where we're starting to open up the prospects of these upside call spreads leaning into January as a possibility 53 days out. So again, same thing with Barrick Gold as well. As we look at other metals, right? So if we see the economy's weakening, it doesn't exactly favor steel stocks, but as of right now, are we buying into the recessionary scenario? Well, I don't know, right? So right now, Cleveland Cliffs is testing a high. CLF is an iron ore producer. It also produces, steel, components as well. The idea is we try to make a nice bounce today. Volume was about average today. Failed going into the close. This is one area to consider watching. You might look for trading through today's high, staging somewhat of a breakout here, but boy, we break. We could readily look at a 19 and a half target on CLF in the near term. And there's other stuff in steel today. Steel Dynamics, for example. This one's not as liquid from an option standpoint. But if we look at Steel Dynamics, this was a December expiration, 120, 125 call spread. Looking at 125 here in the couple weeks, looking at today's move, that might be a reasonable scenario. So what you could do is look at maybe buying the stock at 115, risking $5 to potentially make $10 to $20 in the near term on a swing here in Steel Dynamics. Again, this is not a company that produces iron ore, I don't believe, but it does produce what? Operates as a steel producer and metal recycler, right? Steel operation, metals recycling and operations, fabrication. So again, not producing iron ore, but taking iron ore and producing. So if iron ore prices are falling, this can make their products be more competitive as they're lowering costs and improving margins. So again, breaking out here today on volume. Well, did we get volume? We did above the 20-day average volume today by a little bit anyway. So again, nice move today. Breakout on volume in Steel Dynamics, and it couples with some of that metals trade that's gone on today. Let's take a look at something like airlines. Normally you'd think with the falling in oil prices, this is good for airlines, but just remember is that looking at the curve for future oil futures right now, it's relatively flat. We're not talking about a normal curve or a contango type situation where prices are rising and these back month prices converge with the spot, unlike the backwardation market that we had, for example, in September and October. This is a kind of a neutral kind of market for oil. And again, certainly supply data, as we're kind of coming back into that 5-year range, has gotten better. There's not really a bear case or necessarily a bull case for oil here. Again, it's relatively neutral. So as we look at stuff like American Airlines, this company's already got a nice little boost off of its lows of about 11 up to as high as 1269. Made a nice run here over the last several weeks. Oil prices could rebound off the lows here, putting pressure on a stock like American Airlines. This was out here in a June 10. It's a longer dated expiration. As we move out here, June 10 out here at a 12,000, and we got 6,000 down here, 12,000 at the $6 strike as well. Looking at downside call buying in American Airlines. Similarly, Delta Airlines as well, experiencing some downside option activity. This is for this week, 3,000 contracts here, mostly bought at the 35 put. And then we've got SAVE, S-A-V-E. So on SAVE, we've got the 1D $12 strike price down here, probably bleeding to the $12.50 as well. We're seeing downside put option buying. Now, again, you could look at those individually or look at something like JETS, which is an ETF that tracks the space, which was down 1% today, 1.25. Could we see a retest of 15.5 or down as low as 14.5? Absolutely. It's a real possibility, right? If we're experiencing economic weakness, if people are traveling less, we'll see how this holiday season goes. But do you want to play the potential downside in JETS? Again, a spread I was looking at earlier in my class, and I put this one as well, but this is for a January expiration here. We're playing the downside from 1686, which is slightly in the money, and selling at 1486. Why? Because this is 27%. That's 30. There's something here to sell that actually reduces our cost by about 20%. And so why not sell it, right? The notion is 1486 is towards our lows down here. If we can come down, we're already in the money. We continue breaking the money. This should cause those returns to expand at currently around a 61 debit. If we get in this kind of 15, 16 area, should be able to close that spread for probably 70, 80% of max gain. Again, with a January expiration, not a bad setup. And so why I consider taking it today as well. As we look at cryptocurrency, stuff like Mara, this is a different play on gold. And frankly, these mining stocks aren't great. These aren't great companies, but they do have high short interest. And if Bitcoin performs well, it creates kind of this short squeeze. Coinbase is one of those companies that are in the high beta ETF. So I've reviewed before for a short squeeze. Mara is another one. coin outperforming this time. But Mara, again, looking today on Mara, it was a 5 Jan 1250. So we went 5 Jan out here at the 1250 strike. Again, just more interest coming in, buying these out of my calls. Yes, they're probably hedgers, but guess what? It still eats just the same, right? So the idea is that we're looking for upside movement in gold and crypto. We're looking for downside expectations in airlines, and again, the potential for metals to have a last gasp here. We previously looked at FCX off of its lows back here. It's made a nice run. We could see another leg higher in many of these stocks. And today, it was the steel industry that's in focus as CLF is kind of forming that pennant formation, or I call it more of a pennant than a symmetrical triangle, just given the amount of time and the big run. But the idea is we could see 1950 as upside here. So the idea is putting a little bit of risk out there, playing the upside swing in some of these names isn't necessarily a bad deal. And AT&T, after a big move over the last little while, looking to maybe break to that next tier, the 50% retracement at 17. Bullish option activity today in AT&T. This is for a 29 Ds expiration out here out of the money at 16.5, 17 at a minimum out here, mostly buying. So again, buying these out of my calls, looking for a big move, 17, maybe 18 is the upside here. It is a little more difficult to play because of the negative skew, pushing the volatility, falling out here to 17, 17 and a half. But you could construct again, buying a 16.5, buying a 17, selling an 18, just a 17, 18 spread, very low probability, low cost, higher reward, a little bit of an edge there. But or maybe you're just looking at the stock as a dividend play in the intermediate term, maybe kind of cutting it loose at 15.5, risking about 80 cents to, looking at a couple dollars of upside plus the dividend. Well, folks, got to wrap it up there. We'll catch you back next week on the video.